All right. Good morning, traders, and welcome to the Pro Trader webinar series, options focused webinar here with Brent Kachuba. So we've had Brent several times in the past. So you guys know who he is. He's been in equities and derivatives for almost 20 years, or I guess 20 years at this point. Worked at B of A and Credit Suisse as both equities broker and in algorithmic sales and trading. Following that, he was institutional sales for Wolverine, representing their electronic derivatives trading platform. And then currently, Brent trades some proprietary strategies and runs SpotGamma.com, which offers the Hero Indicator, which a lot of you are very familiar with, and publishes various metrics on options data, quite a few metrics, in fact. So we're happy to have Brent back again. We have let's see here, his affiliate link and his contact information in here. So if you're interested in their services, I'll put this into the chat, both in YouTube and if you're interested in also in Discord there for you guys, so that you can reach out and find out more. All right, so without further ado, well, I need to go through the disclosures and then let's turn it right over to Brent. General disclosure: all Bookmap Limited materials, information, and presentations are for educational purposes only and should not be considered specific investment advice nor recommendations. Risk disclosure: trading futures, equities, and digital currencies involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results. Okay, so let's see here. I've got Brent's screen up. Let me pop it out. And yeah, I think you are good to go, Brent.
Presentation is up there. Thanks, Bruce. It's good to be back with everybody again. I think it's been a while. So, as it is options week, thank you guys for having me kick this off. The thing I wanted to talk about was sort of a new way to visualize how the options market can impact equities. I think if you've heard me talk before, you understand that I talk about the different influences of the options market, such as how the underlying moves, how volatility moves, how time moves, and all these can kind of combine and congeal into options pressure on the market. And so today what I wanted to do is I sort of wanted to reset that framework for everybody, try a new sort of analogy that I've worked out here, and then explain how these influences may be coming into the market just this week. Bruce, as you may or may not know, there's a very large options expiration on Friday. The quarterly options expirations tend to be very large. So when I say quarterly, I'm referring to the third Friday of each quarter. So that's March, June, September, and December, those 4 months. The third Friday is always a very big expiration, and this time was no different. And when I say it's big, I mean there's a whole bunch of big put positions expiring. And so we believe that can be very impactful to the market. And hopefully this presentation here will show you why that may be and how you may be able to take advantage of it. So the idea I want to present, or the analogy that I want to present to you all, is this idea of an options chair or stool. And when you consider sort of how options impact the market, and I don't want you all to think of this as sort of like you're trying to figure out if I want to buy or sell this single option. I want you to think about this from a hedging perspective, a dealer's perspective. On the top of this three-legged stool here, we have the options price. And when I say options price, I want you to think of that as not so much sort of how much an option costs, right? I mean, in a way, that's what it is. But think about the higher a price is for an option, in this case, one could argue that that means that the hedge ratio, right, or the delta of that option needs to increase. So when I'm talking about options prices here, there are three main factors that determine the options price. That's the stock's price. So if you're thinking about the SPX index, or if you're trading Apple options, that's the Apple stock. There's volatility, in this case, generally implied volatility. So what do traders expect for the market to do? Obviously, we have the FOMC tomorrow, on Wednesday. And so implied volatility, or the amount of volatility traders are expecting in the future, is pretty high, right? Because no one knows what the Fed may do. So, okay, you can watch the stock move around, you'll understand that. Volatility, or sort of how much people think a stock or index may move. Again, earnings usually bring high implied volatility. If a war starts, God forbid, we have more war, that'll possibly raise implied volatility, right? All these things can impact on options price. And then the third one is time. Time is fixed. It's very easy to understand. The closer we get to an expiration, particularly where there's large options expiring, the closer you get to that expiration, the more options decay, right? So that is sort of a factor. Now, in your mind, what I want you to do is imagine that you're holding this stool in your hands, right? You got your hand on sort of two of the legs, right? If the stock price starts to increase, that could tip the stool to one side of the equation, right? And if the stock starts to drop, that could tip the stool to the other side of the equation. Same thing with volatility. If you raise volatility, that'll tip a stool. If you raise price and volatility, you're going to tip the stool. If you start to pass time and shift those other ones, the stool is going to roll over. And so the way that you prevent that stool from flipping over is to hedge your options, right? And this is what dealers are trying to do. They're trying to create or maintain that stable options delta, right? Their hedge ratio, that options price. They want to maintain stability there. And the way they do that is generally by buying or selling the stock, right? They can adjust their portfolio around, but the base sort of line, the baseline that I want you to think about this is that as these three variables are changing, that stock price, volatility, and time, as those are shifting around, you can hedge with the underlying stock, buy or sell the underlying stock, to keep that options price stable, right? To keep that top, imagine you had a ball rolling around on the top of that stool and you're trying to balance it. The way that you balance it is by buying and selling stock throughout the day, right? To keep your options portfolio balanced. So when I talked about this large options expiration on Friday, it was a tremendous week last week. Right? 2 weeks ago when the S&P was at 3,900, we had a very large put options expiration. Then we had an incredible rally, right? 5.5% rally into CPI. And I believe I have a chart of that here. Yep. So we had this incredible rally into the CPI. That's this rally right here. And then an immediate crash. Now, the delta notional, right? This is how much stock in theory or futures need to be bought or sold to hedge the major underlying indices, as the S&P and the NASDAQ. We calculated back here, right, was around $500 billion. If the market started to rally in that position, the stool started to tip way over. And the way that they would hedge that stool, right, would be to buy futures, and that kept the stool balanced. So the reason that is because when puts expire, right, if dealers are short put options because traders are buying them to hedge themselves, if dealers are short put options, then they're going to be hedged with short futures. And if the market starts to rally, right, that chair, that stool starts to flip over, they got to buy futures to maintain balance. And so because you had all those big options expiring, that led to this big cascade of buying, right? And then immediately as the CPI number comes out and is a negative number, and the futures gap down 3% in the course of about 60 seconds, then all of these futures need to be sold back to maintain balance, right? Because imagine that the stool is level, right? Somehow as we hit CPI, all of a sudden somebody just comes over and basically kick the stool over, right? And then it's a rush to get the thing back up, which involved sort of selling futures to get that balance or that stability back, right? To get this thing back to level. And so when you think about the way that the options market's going to impact, or you're watching or thinking about how price is going to be impacted by the options market, you want to balance these things out in your mind. So, right now, I want to advance to sort of how you can take advantage of this kind of concept in the moment. But what I want to impart on you is that on Friday night, this number was back to 500 billion, right? Friday morning, because of the fact that the market had cascaded back down after that CPI. So we had something around the neighborhood of, I don't know, 400 billion maybe notional net in puts, right? Because you want to net these numbers out expiring on Friday. And our thought is that as those puts expire, that leaves dealers short too many futures. And there's this phenomenon, I'm going to present some data on this, but there's this phenomenon where the market tends to rally the Monday after, right? We'll typically hit a low the Monday after options expiration, and then rally after that. And we believe it's related to how these put hedges are unwound, right? Because if you think about it, if you're short a bunch of futures as a hedge against options positions, and then on a Friday you go, options expire, they're all gone, then you have these big futures hedges, right? You're short these hedges that you don't need anymore. So what do? You got to buy those back. I think the other thing that plays in this factor generally is the SPDR's dividends. There's a couple $1 billion in SPDR dividends that come out, right? Those will get reinvested and the like. So I think oftentimes you get kind of this kicker, right, on Monday after these big options expirations. And And this is not really a phenomenon that, as I mentioned before, you can see this phenomenon sort of the market turning around big options expirations. You can see it pretty much every month, but the quarterly options expirations are where this really shows up. As I mentioned before, it's the quarterly options expirations that are the large expirations, where the biggest options positions are. But you can see here, back in June, right, we had the June FOMC, and then here's June OPEX, and the market rallied pretty hard after that. Same thing in July. We had this gap up. Right around options expiration. These were expirations that had a lot of puts in them, just like we had here in September. One interesting thing about August is that August was one of the only months this year that we expired with bigger call positions, right? We went into expiration with bigger call positions than put expirations. And what you can notice is that we gapped significantly lower, right? We went the other way. So just as I said, after big puts expire, we'll get a rally. After call positions expire, we see oftentimes the market will sell off. And so there is this link between options expiration and the way that the market moves. So I wanted to sort of add some data and some thoughts around these big options expirations. This is the sum of returns in the last, so these are 5-day sums just for this year. And what you can see is that these red arrows are options expirations. And what you can see is that there are these cycles we get into, right? And the reason I think these are these cycles where it's a negative cycle here, positive, and then we kind of go negative. It's like a waveform, right? And oftentimes that wave seems to cross sort of this zero bound around options expiration. And I believe that is because we call it the options cycle. I believe that's because as you get closer and closer to an options expiration, that's basically every 30 days, the positions build and that reinforces trend. So what do I mean by that? Well, as we build into a put options expiration, right? Like last week, puts get larger in the market. It creates more volatility, a little bit more chaos, right? Things tend to get a little more wild. And then on the call side, call positions tend to build in implied volatility, right? That other leg of the stool shrinks down to not be as meaningful anymore, and the market stalls out. Then calls expire, and then volatility expands again. And you can see again this waveform. And if you look at it, this is a chart actually presented by Sober Look on Twitter. You can see right here. Reuters also put out an interesting chart. We did a video about this. If you look at our YouTube channel, at which is YouTube/SpotGamma, you can see this a discussion of this chart. But what I want you to know is this is the week return into expiration Friday. So this week, the market's return for every week going into expiration Friday has been extraordinarily negative. Right, it's slightly negative the last couple of years, but very, very negative this week. Last week. That's going into options expirations. And then look at the return out of options expiration. It's massive, 2.3%. So that's a huge swing, right? Going into options expiration and then coming out is so positive. Now, I mentioned this year that we've had primarily puts in the market, right? It's a different dynamic than anything we've seen really in the last 5 or 10 years. This data here, where we're minus 80%, I think this is very skewed by the whole March of 2020 escapade, where we had the giant market crash. So the point here is that these are call-dominated markets, and you can see the returns are smaller. It's a little bit of a different dynamic, right, where there's bigger call positions in the market. And then this year, you just get kind of chaos into options expiration, and then it's still chaos out of options expiration. It's just it tends to be a big rally. Now, if you've sort of been subscribing to our daily notes here, you know that we are looking for a rally in the market, looking for the market sort of shift back over 3,900 today and kind of rally back into FOMC. And then, that's kind of what the difference is here. We have FOMC on Friday. And so, back to this leg of the stool here, right? We think market will rally, but volatility is not going to go anywhere because you have FOMC. So what's going to happen on FOMC is you're suddenly going to get the stock market's going to react wildly, right, to whatever may happen, however the Fed positions itself, and then volatility is going to react in kind, meaning that if the market rallies, volatility is going to decline, implied volatility is going to drop like a rock, right? And that will likely dealers need to buy futures, right? So balance that stool back out. Conversely, if the market drops and volatility really spikes, then dealers are going to have to sell futures to keep balance. And that could really, start a major trend for the next couple of weeks. So in line with a lot of this idea here, what I wanted to just touch on is this idea of volatility a little bit further. If you all want to think about the VIX as our measure of implied volatility in the market, and when I say implied volatility, all I'm talking about is what does the market expect in terms of future volatility? How much movement is the market anticipating? And that's essentially what you get when you're looking at the VIX. Now, a lot of people think, okay, well, if the VIX is high, it means the market's going to crash, or people think it's going to crash, and that's part of it. But ultimately, what the VIX is really just telling you is that there's going to be a lot of movement. We tend to assign a negative direction to that movement, but there's nothing to say that the market can't rally and have a lot of volatility. And I bring that up because many of you have obviously seen incredible moves higher this year, right? We'll rip 5% in 2 days like we just did. It's just we gave all that back in the matter of 60 seconds, right? So what we're looking at here is realized volatility, which is how much the market has moved. This is the S&P 500. How much the market has moved in the last 30 days. So what I want you to focus on here, what I want you all to see here is that this is 2022. And what you may notice is that we have a higher level of realized volatility. We have more sustained market movement this year than at any point in the last 10 years. Right? There's a few kind of episodic reactions here, like flash crash. At the end of 2018, the market had a really bad year. Obviously, the COVID crash is here, but that volatility tends to calm down after a while, right? What you generally have is the Fed will come out and say, "Hey, everybody, Fed put is in place. We got your back," and the market calms down. We are not getting that at all this year. It's a much different environment. Many of you who watch the VIX have seen, okay, the thing doesn't go under 20 anymore, right? We seem to have this sweet spot around 25, and what that is telling us, obviously, is that there's more volatility in the market, that traders expect more volatility in the market. Well, you have to expect more volatility in the market if the amount of realized volatility, so if past volatility is high, then we're all going to expect future volatility to be high, right? That's sort of, you set your base case for what's going to happen in the market based on what's happening. And so this realized volatility, right? This is a different regime than we've seen arguably in the last 10 years. And the interesting link here, and I don't cover the macro as much, but the interesting link here is that the Fed is increasing rates, right? They're tightening. They are not offering that same Fed put, and the market this is a different market now, right? It reacts much differently as a result. So many of you, and I get this question a lot, so many of you may wonder, well, when is the VIX going to go back down to 15 or under 20 or whatever it may be? And while you would say, look, if we get realized volatility back, 2017 was probably the most boring year ever, and the VIX got around 10 or 11, right? You see, realized volatility was just absolutely anemic. This realized vol, you can sort of look at it and say, okay, realized vol is right now around 25. You can kind of just compare that to the price of the VIX and say, what is essentially fair value for the VIX? Well, it's basically what realized volatility is, right? It's basically about 25. Now, if the Fed put comes back out, traders' future expectation of volatility is going to crash, right? The VIX is going to drop hard, and it will take realized volatility a little while to come down. But as we're sort of just sitting here, the best sort of way to think about is the VIX fairly valued is based on what 1 month realized vol. So if 1 month realized vol, i.e. this number here is about 25, well, then the VIX about 25 is probably about fair value, right? So what this chart does is it takes the VIX and it subtracts 1 month realized volatility. So it just subtracts this number here. And this is the spread between the two. And as you can see, we tend to revert in and around 10, right? That's generally the spread here. You can see sometimes this spread gets negative, and what that is like after the COVID crash, right? The Fed put comes out and the market rallies hard and the fear is over in the market. That's what all these negatives are, because traders go, okay, the catalyst for the market crash is now behind us. We have Fed support. It's all good now, right? And then the VIX will very sharply decline, but it takes 30 days, obviously, for these big, realized moves to come out of the market. So that's what the other interesting thing is here is that you get more of these. It seems like more of a cluster of these situations where people try to keep saying, okay, I think the nasty part is over here, right? I think we can move forward here. And then all of a sudden, the market just sort of sells back off, right? And VIX flies back up. But the point to get back to here is that this spread is pretty much in line, if not slightly lower than where we've been over the last 10 years, right? So based on this lens, the VIX at 25-ish is pretty fair value. People aren't really asking for much extra. They're not expecting much more movement than we're already getting. So if you think about the rule of 16, and what that basically tells you is that you can divide the VIX by 16, and that gives you a 1 month forecast for what people think the market's going to do. A 1 day forecast. And so with the VIX around 25, 26, you're getting somewhere around a 1.5% move. Essentially is what the forecast is, right? It's what the market is expecting for the S&P index on a 1 day move is roughly 1.5%. That's a lot of movement, to have that as your average case basically over the year. But I think most of you would say, well, yeah, we can get a 1.5% move, but it very easily could get a 2 or 3% move today, right? Because of the fact that I think liquidity is very low and we just tend to whip around. So, 25, back to my sort of core point here, 25 is a fair value. It doesn't seem expensive to me, right? It doesn't seem like people are pricing in bigger movements than 1% moves per day. Now that is high, but again, doesn't seem like excessive, based on this spread chart here. You obviously are always going to keep a little bit of a premium on implied volatility, the base case, because most people don't know what's going on in the future, right? You have to sort of look at your base case is realized vol, then you add a little bit extra on top of that, right, in terms of your future forecast because of unknowns, right? Again, war, interest rate changes, et cetera, et cetera. You want to hedge those, right? People generally want to own puts to protect their portfolio. There's some demand there, right, that keeps a little bit of extra juice in the VIX over realized. And again, from this chart, it just looks like we're fairly valued in the VIX. So if the Fed comes out and says, hey, everybody, I got your back now, Fed put, no more hikes, the VIX is going to collapse, right? And if the VIX collapses and you drop, and that volatility component drops hard, then it's back to this idea of the stool, right? The stool is going to flip forward and fall down because dealers will suddenly have to start buying tons of futures back to stay level. Right, so that's why we want to watch the VIX and pay attention. The VIX kind of tells us how much volatility is in options, right? And if you think that the Fed has your back and the VIX drops to 20, well, that tells us that dealers got to start buying futures back to maintain their hedge, right? To keep that stool balanced. And as the market rallies, right, they got to buy more futures back to keep balance in the market. So that's why this is such a critical idea. When you look at again, the VIX, if you guys go to VIXCentral.com, you can look at this VIX term structure. And again, the reason I'm showing you all this is because I know many of you are obviously here trading futures, and the movement of volatility, right, is so critical to understanding what options dealers may or may not do. Again, lower VIX, lower volatility generally means dealers are going to buy futures, and a higher VIX or higher implied volatility generally means they'll need to sell futures. And so this line here was from September 15th. And then obviously we had just, because of the Fed, because of FOMC, we have this premium, right, in VIX. And what's going to happen now is the Fed is going to come out and say one thing or the other, and the market is going to react to that, right? And if people are spooked by the Fed, and you look at VIX Central and you can see these lines flatten out, right, or go backward dated, meaning that the front month data points are higher than the back month, that is a signal that the market is concerned, but it's also a signal that dealers are probably going to start having to sell futures, right? And that's going to really crush the market and add a lot of pressure. Conversely, if people like what the Fed has to say and you see these lines converge or collapse, or you see just, volatility of 28 goes down to volatility of 25, okay, the market is breathing a sigh of relief, and the market is going to start to rally off the back of this, off the back of the FOMC. One of the things that I really want to bring this all home for those of you again who've been following me for a while know that I talk about the MOVE Index, and what the MOVE Index is. It's the VIX for Treasury options. Works very close, very similar sort of logic there. And if implied volatility is high in Treasury options, it's the same thing as high implied volatility or high VIX in equities, right? It means the same thing. People are very unsure about the future prices of Treasuries. Now, that's sort of the basis for most of the global financial system is U.S. Treasuries. So the fact that the MOVE Index is telling us that there's as much anxiety in options pricing on Treasuries, as much anxiety today as there was going back to March of 2020, that is to me a signal that the core sort of, the belly of the global financial beast is upset. And I've argued that, while this is elevated, if you look at the VIX which is here in yellow. And if you look at VVIX and the SKU index, these are equity measures, right, of tail risk demand. Those are all at lows going back to 2019. So specifically, if you look at the SDEX, that basically the SKU index, the SDEX, it tells us what the demand is for out of the money puts, essentially, right? Are people worried about tail risk in the market? If they are, then the VVIX index, right, and the SDEX index are both going to be higher, right? Those are the VVIX is essentially demand for out of the money VIX calls, something that you'd want to own if you thought that the VIX was going to go to like 80, right? So nobody's worried about in the equity space. We're not all that concerned about that drawdown relative to this gap in the MOVE index, and so. When will implied volatility really start to drop, and when will we get the VIX under 20, and when will we get a sustained market rally? I believe it's when the MOVE index comes back down under 100, because that tells us that the treasury market is now finally breathing a big sigh of relief, that interest rates are probably the path of interest rates going forward, is more predictable. And then, that helps things out from a fundamental perspective, right? Because you can start to price future cash flows, and you can start to look at, what the yield of the S&P is versus 10-year treasury. And you can sort of all of these normal barometers for asset allocation, right, can suddenly come back into use because, we have better, a more sound sort of anticipation of prices are. And so, that's our signal for long-term, wanting to get back into the equity market long-term. But even in the short term here, the fact that this gap is so big, right, tells us that we are not going to get realized volatility. This number is not going to come back down, and swings in the market are going to remain very, very high because the more volatility we have, right, the more this stool is going to flip all over the place, and the less out of balance we're going to be as a result. So again, what we were saying this morning on our in our subscriber note, if I just flip back over to a live chart here, what we were saying in our subscriber note is that no one really knows, number one, what the Fed is going to say. Yes, we have an idea of, our rate's going to go up at least 75 bips. Okay, are they going to go up 1%? Some people think that could be. So that's one side of the coin, but the other one is how are people going to react to that? As trading mentors often say, it's not the news that matters, it's the reaction to the news that matters. And so, we think very cleanly here, you just wait for whatever the Fed may say, and then you wait to see how the market reacts. And then because of this VIX at 25 or 30, because of options expiration just rolling off, right? Because of some of these different dynamics, we think that there's going to be a very extended move. So a 1 to 2 week directional sort of, move out of the FOMC. That should be very tradable. And if you look at the way that this lines up, you can see we're going to roll into this quarterly expiration. And many of you are aware of the end of month quarterly expiration because there's this big trade called the JP Morgan collar. I don't want to get into that on this trade here, but if you look at our YouTube channel or just Google, JP Morgan collar trade, you'll get a bunch of information around that. But basically what that is there's very large put positions down below. So if I zoom out a little bit here, take my lines off the screen. If we sort of zoom out here, you can see there's a big long put position down at 35.80. I know this is far away from where we're trading right now. It's about 6%-ish below. But this number, I think you should keep this one in your mind until the end of the month. Because we could see, I think, off the back of the Fed, if it's not a good reaction, I think we could very quickly slide, this far, this fast into end of month and see this long put strike. So essentially, JP Morgan is long the strike and dealers are short the strike. And so as the market starts to slide lower, dealers are going to have to start selling futures. This is the biggest position sort of in the market right now. And because of the fact that the time is starting to shrink on it, it becomes a little bit more sensitive to the way that the market is moving. And then the way that they do it is they sell the long strike. So it's hard to see here, but this is the JP Morgan. What they do is they sell this call at 4,005 and they use that to buy this put, and they actually use it to buy a put spread. So that's why these levels, the 4,000 level, and then this 35.80 are very important into the end of the year to watch. And again, it's this idea of the dealers needing to maintain balance, right? If the market starts to slide lower, they got to start to sell futures. If vol starts to spike, they got to sell more futures, right? Because the volatility is going higher. They got to sell more to maintain that balance. Conversely, if the market starts to rally, these puts are going to get destroyed in value, and the market's going to start to head up, and then dealers got to start buying futures, right? And vol is going to come down, so they got to buy more futures to maintain that balance. So, it's all about this equilibrium, and that equilibrium can exert, a lot of pressure on the markets, as this original chart that I showed here implied or inferred. So that is my very quick overview on sort of the state of affairs here in the options market and what we're looking at. I'm happy to take questions, Bruce. I don't know if we can take questions on how that really works in Discord again. I'm sorry, I'm a little bit of a Discord boomer here.
Oh yeah, it's no problem. I can read them out to you.
Okay, cool.
And we also have some from in our YouTube channel there. A few different
Okay, great.
questions. Yeah.
Yeah,
So,
happy to field those.
okay. So let's see here. In Discord, when you talk about options levels 3900, you mean SPX or is it the ES December contract?
Yeah, great question. So all the levels that we quote are in index, and the reason is because we model index options, and so we quote the level in the index, and then you do need to adjust it to the future, and obviously that spread changes over time, and we do some adjustment on our side. So what happens is when you actually look at our levels, like if you load them in Bookmap, we print a label that's in SPX terms, so you know explicitly what we're talking about, but then you actually see the line drawn on the Bookmap chart at the equivalent ES, as you can see here. So these are our key levels for today. Obviously, a bunch of these aren't in play because we're a little too far away, but here are the equivalent futures levels. And so just back to that point, we've been looking for a bounce today based on that OPEX bounce information. We think that 3,900 or back over 3,900 was our call. We made that call actually on Thursday. The market kind of went down against us on Friday, but we're sticking with it into today. And we think that the rally, normally we look for a little bit of a sharper rally into options expiration, but because of the fact that the FOMC is on Wednesday, we think that's going to keep volatility high in the market. It's going to keep some tension in the market, and that kind of limits how much the market can rally today. So, I think I'm thinking we'll get into around the 3950 area, kind of into Wednesday morning, and then we're just going to hit the pause button there while people wait for the Fed.
Okay. Let's see here in YouTube. We have a question about you never heard of the Fed put before? Is that a real thing?
No. So there's a famous sort of quote. I think it's Ben Bernanke, and basically what they say is the Fed put is that the Fed is hedging the market. And what that essentially means is that when the stocks crash too much, the Fed would roll out like quantitative easing or some other sort of support for the market, right? And so that's why people have said, well, it's the Fed put. If the market drops far enough, they'll come and save us. And that Fed put is arguably not there anymore because here the market is crashing and the Fed's going, well, I'm going to raise rates, right? Or I'm going to launch quantitative tightening, even though the market's down whatever 15% or 20% this year, we're going to keep ratcheting up interest rates. So that's why people say the Fed put is no longer in place.
Yeah, and then you were talking about the JPM collar. So we got a couple of just different comments about that. That should suppress the volume or volatility there.
Yeah, so a lot of people say that this should suppress volatility, and my argument about that is, so the reason that people say that is, if I move my screen over a little bit here, zoom out. All right, so the way that this specifically works is JP Morgan hedge fund is long a bunch of stock, right? And they want to hedge that. So what do? They sell the call, right? They sold this call, the 4,005 strike call, and they use that to buy a put spread. So the put spread they bought is 35.80 and short the 30.20. So the dealer position is going to be the exact opposite, right? Dealers are long this call, they're short this put, the 35.80 put, and then they are then long the 30.20. So the idea with that volatility suppression thing is that when this short put here, right, JP Morgan short this, but dealers are long it. So if we get down here and vol really spikes enough, then dealers are long this put. They're going to start making money from that position in theory, right? If the market drops that far. And that's why that should suppress vol. My argument here is like we got a long way to go till we get down to this 30.20 area. This 35.80 put is going to lose a lot of money, right, before this trade here makes money. See what I'm saying? So this call that market makers are long, or dealers are long this call, they're short this put, and as a result, as the market goes down, they got to sell futures. So as far as volatility suppression goes, I don't think that's going to kick in until we get, maybe down to 3,200. That's a long, I mean, that's a long, long ways in the next 10 days, right? But I do think getting near this 3580 with some bad Fed news is possible. That's what 6-7% down from here.
Yeah. I mean, I always walk away from your presentations like it's inevitable, you know. Uh,
I mean, I literally have no idea, and this is the thing about it. And we were talking about this in the CPI number, right? We said we it's about the distribution of outcomes ultimately. And what I mean by that is that I don't know which way the Fed is going to go, right? I didn't know if the CPI number is going to be positive or negative. Fascinatingly, I mean, the thing that boggles my mind, I'm going on a diatribe here. I tend to do it, but no one's going to be able to answer this question. But what I found most interesting is we wrote every day, and quite frankly, like we understood that the options market was helping drive that rally of 2 weeks ago where we rallied, 5.5% right here. But this didn't make a whole lot of sense. And the thing that really didn't make any sense is everyone's watching this CPI print, right? It's almost like an FOMC. Like people hedge the FOMC or the CPI like they would hedge an FOMC event, right? And the futures hit a like major high. What is that? I don't know, 3-4 week high, 30 seconds before the CPI number comes out. Why would you? Who is that? Just a shortcut? Like I don't know. Again, I'm on a side diatribe here, but I just couldn't believe that we're actually hit like like a multi-week high or whatever 30 seconds before this print comes out, and then you can see this really destruction. So back to the point of the distribution of outcomes. If it was a good CPI number, we've already gone up 5.5%, right? All of this put fuel that was in the market had burned up to essentially zero. So this was again sort of the extreme reading. But if you look at this on the morning of the CPI, this is call gamma here, or excuse me, call delta here and put delta here. So what happened was the call delta and the put delta were even numbers. Essentially, all of these deltas that were in the market, right? This is the size of hedging needed just for puts. They had essentially moved to equal. And what I mean by that is that dealers had to buy back all these futures as puts were losing value. And then when we hit this point right here, that hit equilibrium, meaning that dealers didn't have any more hedging to do. So when you're looking at the distribution of outcomes, you go, okay, well, what's the reason? What is the impetus or what is the options fuel for the market to rally on a good CPI number here? There's really not much fuel left. Like the market's not going to sell, but there's not a whole lot. This fuel is not there anymore. However, if it's a bad figure, right, and we wrote extensively about this, if it's a bad figure, there were all those put options that were expiring on 9/16 that were just sitting there. And while they're worthless up here at 41.60 or 41.75, if we drop, those are suddenly going to gain a tremendous amount of value and have to be hedged very actively. So this is what we call jump risk. Market drops here, and this means suddenly, to keep that chair balance, you got to sell tons of futures to maintain that hedging, right? It causes this cascade effect. Now the biggest options positions are out in October. They're more out into December now. So we don't have this same jump risk, right? The Fed's going to cause a move, but we're not going to get a 3-4% move in 30 seconds. I mean, I think this was the fastest 100 plus handle drop I've ever seen. I think it was something like 30 seconds. I mean, it was just unbelievable. So back to sort of the original point here. You want to look at the distribution of outcomes. And as you can see here, when we're talking about the fact that, yes, this JP Morgan leg is, 6% down. That position, the fact that position is there, as we keep getting closer to this position, the more downside fuel it adds, right? Because as this put increases in value, it tells us that dealers got to arguably sell more futures to maintain hedges. And so it's almost like a vacuum, right? You start to get close enough, or like a tractor beam, like a UFO spaceship, right? It's going to suck you up. Well, that's what happens. You get close to 3580, that put value grows and it helps to pull the market down.
Well, I mean, what would happen, Brent? I kind of hate to go this direction, but I just have to ask. If the news is good for the market, All of this will have to unwind here, or JP Morgan will have to figure out something.
Yeah, I mean they're already long equities. So for JP Morgan doesn't care. They don't touch this position until expiration. So it's going to expire on 9/30, and that's why we have on this chart here. It's this idea that price and volatility are two of the dimensions, and then the third one is time. So this is when those options expire. This the JP Morgan puts, and so if we rally out of this put doesn't have a ton of value right now, right? But the closer in time we get, it's going to lose more value, right? And as we start to rally, that put also loses more value. So, those are things that decay. As those decay, that helps keep the market up. This put position by itself right now doesn't matter all that much. But if we move down 2% or even 3% after the FOMC, then suddenly this thing starts to spike in value, and then you're going to hear a lot more about this 3580 put. But right now, the base case is the Fed sort of, let's say we get 75 basis point and the market's like, okay, I think we're all right now. Let's start to rally. Then you got to wrestle with this 4,005 strike on the overhead. So, if you talk about like a quick move, 4,000 is a big resistance level. I mean, if you just look at, an alternative view here for that. So this is the gamma by strike. And so call gamma at the top, put gamma at the bottom. This is essentially telling you like how big are the positions, right, at various strikes. So you can see this is a monster strike here, the 4,000 level. This level right here is the 4,005 JP Morgan call explicitly. So the upside, we have this big strike that the market's going to have to wrestle with. We could very quickly move that level and kind of stall there for a little bit. But to the downside, that 3580 is not that big of a deal, right? You can see down here, there's a small little piece, but this is not a big put position right now. So if the market starts to go up, well, look, there's not much to decay at this strike. But, all these have decent amount of gamma. So that'll help to fuel the market up. But if we start to jump down, you're going to see the value of this line will drop substantially, right? That tells us that put value is increasing, and think of this as the amount of hedges necessary for each strike. As the market suddenly gaps down, all that hedging flow needs to pick up. All that hedging flow is start selling futures, right? As the market starts to move down. So, the distribution of outcome, we're right around here. A good Fed easily get up into this level, then we're going to test this level and then, kind of take it and see it. But if we start to move down, there's really not that same, support mechanism of options expiration. And I think it's a support mechanism because when puts expire, they don't have to be hedged anymore. So that removes some of the volatility in the market, right? We can get kind of like a bounce like we're seeing today. But because there's not a close expiration now for another month, those puts are going to sit on the books for at least a month. Some of the bigger positions are out in December. That keeps pressure on the market, right? There's nothing to break the cycle of downside, if that makes sense.
Yeah, no, great stuff. So another question here about wouldn't JP Morgan be just front running the CPI or I guess larger players here to extract every last profit just in turn to the short?
No, so it's that hedge position. They do not adjust for that, right? They put it on every end of quarter. This is the date, right? They're gonna get rid of the existing position. They let it expire, and then they put on a new position. Now they may kind of change the way they add a new position, I think, because the market starts to watch this so much, and you want to kind of disguise maybe what you're doing. But they're not here to, they're already long a whole bunch of stocks, so they're not here to monkey around with, trying to game the system. I think in this respect. So, and in general, I think, yeah, will this suppress volatility? If we get down below here, then I'll make a case that it does suppress volatility. If anything, you could say that if we rally here, right, because JP Morgan short this strike, dealers are long this strike, 4,005. If anything, you can make the argument that as the market rallies, dealers got to sell futures in some size, right, as the market starts to rally, which caps the upside volatility, right? So, if you start to rally there, then I guess if that's what the previous question was about upside volatility, then you can make an argument that's getting suppressed above 4,005. But that fund is already long equities. Like that's their mandate. Their mandate is not to sort of try to be arbitrage and play around with CPI or FOMC events.
Yeah, wow, wow. This is great. I really like the stool visualization there, Brent.
Yeah, I think I got to change it to a chair. I got one more leg. The other leg here is interest rates, which is also kind of like you think of interest rates or dividends or even short. The cost to borrow, all those rates kind of factor in and could cause a little bit of extra wildness too. But for the index people, I just tried to leave it a little bit more simple, and hopefully that's a better visualization for the dynamics.
Yeah, let me see if there's any more questions in.
I'd like to get a rally over 3,900. It's an egg on my face here the last few days. Looking for this rally, and a lot of puts were closed here. That really helped the market rally, and then obviously we're getting there today. But people are still pretty nervous out there, huh?
Yeah, yeah. Well, I mean, I think a lot will revolve, like you said, around this FOMC, for sure. Brent, what do you also about like the quad witching? How do you kind of factor in that when you have the futures as well and options on futures expiring?
Yeah, the options on futures market, I've looked at it before. I think there can be some material positions there for sure, and I don't want to represent that it doesn't matter. That in a way kind of adds to the existing position. So you're not going to have the ES futures options market in generally like way off from what these spiders or SPX is doing, because that would present too much of an arbitrage situation. But when you have those contracts expiring, I think all that just generally adds to volatility, right? Because everyone's sort of forced to trade and make adjustments. And so, I think that's why those quad witchings are so large. It's just because everybody's got to trade around those times, right? Some of the flows are easier to track, like what is the real impact of the roll, right, from, SEP to D's contract or whatever. It's a little tougher to track versus like, that's what makes these options expirations so important, is because everybody has to trade them. The positions are going to expire. So, if you just own spider puts, right, and you choose to do nothing, well, you're going to be assigned short 100 shares of spiders. So you forget about it and you wake up and suddenly you're short 100 shares of spiders on Monday. Maybe you got to cover them. Also, you also add into that the dividend, right? There's all sorts of effect from the spider dividend that comes out. You don't necessarily don't want to be the short the stock on Thursday because you don't want to pay the dividend. And so all that just kind of adds to the noise and volatility, because those expirations force people to trade, like they force people to do something. And I think that's why they're kind of important. And where we think we have that edge is just, again, in the index options market and the equity options market. The trouble, honestly, with the ES options market is that the CME, they make it nearly impossible to get the data. So that's why you see, there's a few other people who kind of do something similar to what we do now. None of these players, even if you look at like the Nomura notes that show up on Zero Hedge, Nomura bank notes, very few people talk about the ES options because it's very hard to get the data on those, because the exchange just kind of keeps the lock on it.
Okay. Let's see. I think that's it. No more questions here.
Cool.
Yeah. So, yeah, thank you very much, Brent.
Absolutely.
And yeah, always a pleasure having you here. Just so much to learn about options and how kind of, I mean, you've been doing it for years, but how tricky it is at putting all of those pieces together, and then like your hero product, the hedging impact real-time options within Bookmap and the order flow, and putting those pieces together in a kind of simplistic way to use this information for kind of not just a longer term, but also a shorter term vision here. So like today, you're bullish.
Yeah, and so if you're watching Hero on your Bookmap system, what you should see is that Hero line, right, should start to trend higher. And what I mean by that is that we're watching every single option trade come in, and we're saying, okay, is this option bought or sold, and what's being bought or sold? Is it calls or puts? And what we would expect to see is people selling puts today. So that would generate what we call positive deltas or a positive Hero signal, and those positive deltas indicate that dealers and market makers need to buy futures, right? So if that hero line is going up, dealers need to buy futures in theory, and if the line goes down, then dealers need to sell futures in theory. So it's always fascinating to watch around FOMC as well, because the market may react in one way, but then you want to see how the options market is really positioning themselves, right? How are people and think of options as leverage, right? So where are the levered bets coming in? Are people selling volatility after the Fed? And if they're selling volatility, that means that the hero indicator will go up, and that's a signal that, okay, the options market thinks that we're about to go higher, right? That the stocks are about to rally out of the FOMC. And conversely, if you get a negative hero signal out of the FOMC, then people are buying hedges. They're worried that the market's about to crash.
Yeah, there you go. So guys, people like Doug Pless is I've been using this information from Spot Gamma within Bookmap with the hero to come up with all sorts of strategies. He'll be presenting on Friday, so some really good stuff in there. Brent, I know like it was kind of interesting when that hero indicator came out, I think about a year ago.
Yeah.
You hadn't seen anything like this before.
Yeah, we definitely, and we're so grateful to Bookmap as our partners there, because we never seen anything like that, and we thought that the application was obvious. And I've done some manual work where I'd get old trade data and cross-reference things, but y'all stepped up and helped us to build out that signal, and I think it's been really valuable to a lot of the traders that use it. It's kind of shifted to be an indispensable tool, and someone like Doug does a great job of showing exactly how what the correlation is right between that signal and the options market. And we're constantly striving to improve that signal and add new things, and we think it's really the kind of the best way to see what the real-time impact is of the options market.
Yeah. No, it's great stuff. And so I put your links into both YouTube and our Discord channel for a special offer from you for Bookmap. Also your Twitter, your email, and then also your website there. And the hero indicator on the Bookmap marketplace as well. So it's all in there, guys. If you have any kind of questions or information, you can always reach out to Brent at Spot Gamma.
Yeah, thank you so much. And if you subscribe to Spot Gamma Pro through the Bookmap portal there, we write a note every single morning that gives us all the daily views or what we think is going to happen on the Fed. There's a 7-day free trial with that. So this is a great week to try it out, because you got the implied volatility dynamic, the options dynamic is really, I think, impactful because of the FOMC. So good week to try out the trial, so to speak.
Excellent. Well, thanks so much, Brent, and we'll have you again soon.
That sounds awesome. Thanks so much, Bruce. Take care, everybody.
Bye-bye.